The number one question I get asked right now is, Jeremy, everything I own has got crushed this year. My equities, bonds, crypto, commodities, everything's got smoked. Everything except my fine wine, which seems to have done, well, fine. Why is that? My name's Jeremy Howard, co-founder and CEO of Crew World Wine, the world's leading platform for portfolio management, secondary market trading and market access for fine wine and spirits. Everything in this video is education and entertainment. Please speak to a financial advisor before making any financial decision. The performance of fine wine in 2022 has been quite remarkable. As of the middle of November, the LiveX Investables Index, the broadish measure of the market, is up 18.4%. Compared with mainstream assets, this outperformance is quite dramatic. But it isn't just fine wine that's performed well in 2022. Knight Frank produced some data earlier this year to show that a wide range of collectible assets had done well. In fact, the resilience of collectible assets in the face of falling mainstream markets led Credit Suisse and Deloitte to recommend that private investors up their weighting in collectible assets over the medium term. So what's causing fine wine and collectibles to buck the trend in this way? We've crunched a lot of data and we've talked to a lot of clients, and we've come up with 6 underlying reasons. Probably the most important driver of fine wine prices right now is the sheer number of wealthy people being created around the world. Again, relying on the data from Knight Frank, we know that there are 610,000 ultra-high net worth individuals in the world. These are people with assets of over 30 million US dollars. But crucially, Knight Frank project that between now and 2026, just 4 years, another 170,000 ultra-high net worth individuals will be created on all continents of the world. Now, Knight Frank estimate that this group invests 16% of its net worth into collectible assets. That's a huge number. What that means is if we assume that just 10% of the money invested into collectible assets goes into fine wine, that over the next 4 years, over 81 billion US dollars of new demand for fine wine will be created. If this demand materializes as projected, it has the capacity to completely overwhelm the fine wine markets. At the moment, globally, fine wine turns over only around 6 to 7 billion US dollars a year. It's really very little. In fact, the total capitalization of fine wine around the world is only about $75 billion. So that $81+ billion coming into fine wine just from new ultra high net worths has the ability to completely swamp the market. It's 13 times the annual turnover of fine wine, and it's larger than all the wine on all the balance sheets around the world. That's merchants, producers, private individuals, etc. And it's important to realize that this isn't hot new money coming into a market. This isn't like funds flowing into crypto in 2021 when prices were rising rapidly and people were just trying to make a fast buck. The research shows that collectors coming into the fine wine market tend to come in for the longer term, looking to build a collection, a portfolio over many, many years. So this demand looks like it's going to be relatively resolute and unchanging over the coming years. So where is all this money going to go? The problem that we're finding is that the primary market, the release of new wines each year, is becoming less, not more, able to support even the existing demand that we have. We at Crew are finding ourselves allocating more and more wines we never had to allocate before. Champagnes, Super Tuscans, Napa Valley releases. There just isn't the supply of new wine onto the market to keep up with demand. And then we've had a number of different instances over the last 12 months of specific interruptions to supply. The Bordeaux 2021 campaign, the yields were probably 20% below the 10-year average. The Burgundy 2021 campaign, which is going to start in the next couple of months, is going to be a bloodbath. Yields lowest since 1981, down 50 to 70% across the board. There are a string of low-yielding champagne vintages too, 09, 10, 11, and these have decreased champagne stocks to the point where the CEO of Moet Hennessy recently said that the company itself was in danger of running out completely of stocks of some of their top champagnes. And this is merely exacerbating a trend that we've seen developing for years, where major producers are releasing less and less shortly after vintage. We know that Chateau Latour left the En Primeur Bordeaux program many years ago, and Chateau Yquem has also done the same. But we see producers like Chateau Palmer making no secret of the fact that they withhold 50%, perhaps more, of their annual production now, so they can release it later. Their argument is that they'd rather release it when it's closer to being able to be drunk. A more sceptical interpretation might be that why should they give this wine away so soon after release, when if they hold on to it for 5 or 10 years they can charge so much more, and in an inflationary environment that's only likely to become more and more of an issue. And contrary to what you might think, there's actually been no reduction in the consumption rate of fine wine. In fact, as companies like ours expand their client bases to new markets, we find, if anything, the consumption propensity is increasing. We crunched the numbers just a couple of weeks ago, and we found that across our Asian businesses, the propensity to consume was so great that after just 4 years, 92% of all purchases had been delivered to home and consumed by our clients. So this all adds up to a very significant demand over supply imbalance. Significant amounts of new money coming into the market, supply erratic, perhaps even declining, and the propensity to consume showing no signs of slowing down. So these are two major drivers of medium to long-term price appreciation. No explanation of the performance of fine wine this year would be complete without a quick note that the US dollar has been particularly strong against the British pound and the euro. This has made all US dollar linked currency buyers have considerably more purchasing power. So buyers in the US, in Hong Kong, in the Middle East, Singapore, even though it's not specifically linked to the dollar, they've all seen their purchasing power increase. And that has only increased the propensity for these buyers to come into the market looking for bargains. Investors are waking up to this idea that collectible assets, tangible assets, are likely to outperform if we do get a sustained period of higher inflation. There was a recent study which we alluded to in a previous video by Man Group, the hedge fund, and Duke University, and they analysed data going back many, many years, and they found that only a few asset classes gave a real return during periods of high inflation. And collectible assets like fine wine were one of those very few asset classes. And more private investors are now waking up to the fact that fine wine and other limited supply collectibles are likely to perform significantly better than traditional assets if we do see this period of inflation extended for a period of time. I personally think it's very important that there's no leverage in fine wine, very little institutional investment. What you see with a lot of mainstream assets where they really fall hard, it's because of a de-levering cycle, whether that's the global financial crisis in property in 2008-9 or some of the recent collapses in crypto prices. They've all been driven by de-levering. Now, I don't know anyone who borrows money to buy fine wine. And really, the institutional participation in our market is almost non-existent. And that's why fine wine prices are so unvolatile. If you look at the Sharpe ratio of fine wine, it's much higher than many other comparable assets. And that's mainly because you don't get these gut-wrenching drawdowns in fine wine. Pretty much all our clients say the same thing. You know, they'll buy wine at a certain price. If it goes up substantially, they might sell some. If it flatlines or does go down, then they're just going to drink it. Nobody's a forced seller. And that really puts a floor under fine wine prices once they've risen. And of course, the long-term drivers of fine wine price appreciation haven't gone away. it's still very, very difficult to increase the supply of almost all fine wines. The vast majority of them are very strictly controlled in terms of where they can be produced. Many of the world's best vineyards, as I'm sure most of you know, have got walls around them. You physically cannot increase the size of the area of production. And of course, fine wine is virtually unique in getting better over time with no intervention from the owner. You just put it away in a cellar and it improves physically in quality and hence in price. Neither of those two things are going to go away. So it's been another year to toast for fine wine investors and collectors, and this year, more than any other that I can remember, the outperformance versus mainstream assets has been quite dramatic. I think we've shown in this short video that the drivers of this performance are not just short-term factors, but very large structural imbalances in the market with very significant amounts of new money looking for homes where supply is erratic and perhaps even declining, and the long-term drivers of price appreciation remain very much in place. So look, no market goes up forever. It's very possible, perhaps even likely, that at some point fine wine prices will take a breather and will flatline for a while. But I wouldn't bet against fine wine prices and fine whiskey too continuing to outperform mainstream assets, particularly if we get a much longer and severe burst of inflation, as many people now anticipate. So thanks very much for watching this video. I'll leave some links in the description below and where you can find some more information, and I look forward to talking to you again soon.